Okay. Welcome back. I guess we can move on. Now, moving on. At this point, I would want to ask whether there are any questions, any contributions, anything that you would want to add on, or anything that you would need clarity on before I move on. Okay. I believe we are understanding what we are talking about, because that's one of my prime aim. Once you understand, I know we are on track. Okay. All right. Taxpayers keeping record keeping obligation. So here, I just want us to understand that as taxpayers, okay, we need to keep proper records. Keeping proper records is not like something optional. You choose to keep your records properly or not. No, it is something that has been enshrined in the laws of the country, both with regards to the laws of Ghana, so the Companies Act, like for example. Also, tax laws had also enshrined that as part of its laws and regulations to ensure that taxpayers keep proper records, because without records, you cannot do your tax audits. Okay, and in our modern age now, we expect that records are to be kept in both electronic and hard copy, but most companies are trying to do away with the hard copy way of keeping documents too. You realize that most companies keep documents in a soft form, which is also accepted by GRA. Now, let's look at 4 key laws that evidence that taxpayers are supposed to keep proper books of account. So Section 27 of the Revenue Administration Act states that we need to maintain. Let's kindly, some of our mics are not muted. I don't want to be giving this instruction over and over. Okay. We need to be able to do the needful, not to disturb others on the class, please.
Yeah, can you please mute or sir?
Okay, I've done that. But ideally, I expect people to be able to do this on their own. Anyway, let's move on. All right. So the Revenue Administration Act tells us how we are supposed to maintain our record as taxpayers. Okay. So records are supposed to be kept by various companies. Now, they expect you to keep records like receipts, invoices, vouchers, contracts, whether in electronic form, whether in a hard copy. The most important thing about the electronic form is that it should be able to be extractable, or the GRA team should be able to use whatever electronic information you have. You can't extract electronic data that is not in a readable format by any of our normal applications. Okay. Now, the most important thing here talks about the retention of records, how we are supposed to keep proper books. And in terms of retention of records, we have a minimum of 6 years to keep records based on what this law is saying. Okay. You are expected to keep maximum of what? 6 years, at least 6 years. So the law says that a document shall be retained for the period of at least 6 years from the relevant date, or for the period following, whichever is longer. Okay, so there are some instances where you should keep records for more than 6 years. Okay, now those instances are exceptions. And as a taxpayer, if you find yourself in those instances, you have to keep the document more than 6 years. Instances like when you are doing an objection or when you are going to a tax appeal, the tax matter must be concluded before evidences surrounding that appeal or tax objection or whatever court case has been resolved. So if it takes 50 years for the tax appeal to be concluded, those evidences must be kept for 50 years. You can't say because the law says 6 years, after 6 years, you are archiving them or you are destroying them. No. Also, if you make an application to the Commissioner General on any matter, and whatever evidence that you used in making that application to the Commissioner General is still with you, you need to keep those documents until the application to the Commissioner General is concluded. Also, if you are seeking for a tax refund, all necessary documents relating to the tax refund must be kept until the tax refund exercise is completed. You cannot hide behind the 6 years side of the law because the law is saying whichever is longer. So these instances are key instances that we must note. Okay. All right. And also, if you received a notice from the Commissioner General on any investigation, the investigations must be concluded for you to destroy whatever evidences that surround the investigation. Okay. The Customs Act also makes mention of the fact that you have to keep proper books at all times. If, let's say, you are operating a custom bonded warehouse, you must have your books open for inspection at all times. So you realize that for custom bonded warehouses, you realize that you see resident custom officers who are there to inspect the books of the taxpayer at all the time, most especially where, so this is how the custom bonded warehouse operates. If you're in a custom bonded warehouse, it means that initially when you imported your goods into the country, you didn't have money to pay taxes on all your goods. So GRA will let you clear your goods without paying the taxes on your goods. Now, you have a custom bonded warehouse that you are going to keep those goods in. GRA would help you with some rules in setting up the custom bonded warehouse. So you are supposed to follow some rules to be able to have a warehouse which is demarcated as a custom bonded warehouse. So for example, it must be spacious, it must have proper ventilation so that the goods are not going to get destroyed. It must be built with the necessary capacity to contain the goods and all that. It must be named with a particular kind of, they have a special way of naming the bonded warehouse with the location and all that. There's the name of the number of the custom bonded warehouse must be visible, placed at a point where people can see and all that. Now, there's a resident custom officer who is in that custom bonded warehouse. Anytime they ex warehouse or they move goods from the warehouse, let's say for production or to sell, the custom officer ensures that they pay taxes on those goods. So now GRA is helping you pay tax at a later date with a custom officer present who helps in taking the necessary taxes for GRA anytime the goods moves out from the warehouse. So that makes sense. Now, this custom act is saying that as a company, you need to ensure that your documentations are open for inspections at all time, okay, at all time. And tax auditors are able to make abstracts from it, okay. If you go to the VAT regulation, LI 2243, it's telling you that as a taxpayer, you have to maintain proper records like your value-added tax account, sales and purchase journals, your cash books, copies of tax invoices and sales receipts, documentation relating to importation and exportation, that's most especially your custom declaration document, credit and debit notes issued, any records with the Commissioner General and all that. So here, the VAT regulation is also telling us to keep some form of proper records. Now, it goes on to say that you have to keep it for a minimum of 6 years. The Companies Act also states that we have to keep proper records surrounding our expenses, revenue, liabilities, equity, and all that. Copies of those records can be kept electronically or in hard copies, and they must be open for inspection by the Ghana Revenue Authority at all times. Okay, so basically, These laws cement the fact that you have to keep proper records, and most especially, you keep them for a minimum of 6 years, barring those other instances of tax refund, application to the Commissioner General, where there's a court case, where there's a special investigation done on the taxpayer. Barring those instances, you are expected to keep your document for at least 6 years. Okay. Now, I want us to just so this side of the lecture, the audit process, I think it has been explained from the outline. As we move on, we are going to delve into each aspect of planning, fieldwork, and execution and completion. So this side is skipped.
Hello, sir.
Yes.
So in a situation where a firm, maybe there's a system crash or maybe a fire outbreak, and it keeps documents or records, paper, form, whatever, and it loses information, are there any provisions for such occurrences?
Yes. So for such occurrences, okay, GRA knows that taxpayers have their way of doing things, and they can have their own way through escaping from tax liabilities and all that by intentionally destroying documents. But then naturally, there are some disasters like your building catching fire, flood, and other things that would make you lose out on your documents. What GRA expects you as a taxpayer to do is to be able to prove to them there was a flood incident, there was a fire outbreak. It must make sense to them. Otherwise, they are not going to buy into your idea of giving an excuse because your office caught fire. So normally, you are expected to detailed breakdown, like a detailed breakdown of whatever happened. And normally, you have to do that in writing, communicate to the Ghana Revenue Authority, even if there hadn't been a tax audit on you. So as soon as maybe your office catches fire, you notify GRA with the relevant document of like the incident that had happened, possibly pictures and all that, for them to know that this is what had happened. And you know, GRA is an institution that is supposed to be reasonable. So once you're able to make your case, they accept it, and that affects how the audit is going to be conducted subsequently. But you don't notify them, you wait for them to come and find out. You don't give them reasonable grounds on which those instances happened or you lost those documents, then there's something fishy, and they would have to carry out their audit with whatever documents you have and apply the necessary rules that they know. Are you clear?
Yeah, I'm clear. But in a case where the taxpayer is unable to prove beyond reasonable doubt the occurrence of such events, what would be the next plan? What would GRA do? Because there's no records to audit. There's nothing to, work with. So what would be their line of action?
Okay. Now, if let's say GRA requests for a supporting document for, let's say GRA wants to ensure that the company expenses are wholly, exclusively, and necessarily incurred. We'll be getting to those principles in a little bit. But then GRA wants to confirm that the company's expenses are actually genuine. They request for, let's say, your rent agreement. You say your rent agreement is bent, right? In the financial statement, they see those expenses as not, let's say, for example, they see those expenses as not allowable for tax purposes because you can't evidence them. You can't prove to them that this is the amount of rent you have paid. Based on their discretion, if the amount is not reasonable, they can say they are adding it back, for example. Now, as I said, this comes with professional judgment. And with the fact of the matter, normally the companies will also not sit down and say, I want to lose my documents. I want to burn my documents. So most often, okay, there are genuine cases that GRA now sees into it and say, okay, maybe let's look for maybe an alternative to verify this. So maybe they see that you are occupying a building. They see that even though you've lost supporting documents on your rent, this is the space you are occupying. The rent amount they see in your financial statement is, let's say, 10,000 monthly. It makes sense for a normal building like this in town to be costing 10,000 Ghana. They can allow it for tax purposes. They will not hide behind the laws and say because you didn't provide supporting documents, they are not going to allow it. Once your facts are quite genuine. Okay. So it calls for a lot of professional judgment in some of these instances. It depends on the audit team and whatever evidences they are able to gather on to substantiate the outbreak, the fire outbreak or the flood or whatever. They are able to play around it and know the best way forward.
Hello, sir.
All right. Moving on. Is someone speaking?
Yes, sir.
Yeah, we are not hearing you. We are not hearing you. I don't know if I'm the only one not hearing him.
Sir, can you hear me?
Yeah, we can hear
Sir,
you now.
can you hear me?
Yeah, we can hear you now. George, proceed.
A classic example, one of our clients got, as you are saying, but the GRA used, they asked for the bank statement as a basis to do the audit.
Okay, so as I reiterated earlier, you realize that the team would use their professional judgment to find alternate means to verify that you get it. So like the bank statement approach, but that is also quite dicey. Sometimes the expenses are bogged up, so you might not be able to see. But like for example, rent, when they were paying, you can see that they are transferring it to the landlord and it might show in the bank statement, so they can easily evidence it. So these are some of the innovative ways you can always back up some of these transactions. Thanks for the personal example you gave. Yeah. I want us to look at the ethical framework of tax audits. Okay. Now, concepts of accountability and independence. I know some of us are chartered accountants, some of us are lawyers, some of us are professionals in other professions. This is to ensure that this career path that we have chosen, it is something that we need to ensure accountability and independence. Okay, we need to be accountable for our actions, and we need to ensure that whatever we are doing, we are going to be accountable for it. One of the basic foundations of our profession in terms of ethics is independence. As tax auditors, you need to be independent of your client. You do not need to have any relationship to have to do with your client. Okay, so this is one of the key things that we need to note. And talking about independence, once you are independent, we say you are able to give a true and fair view of the company's tax position. You do not include any biases in doing that. So now, we have the professional code of ethics, which governs tax audit. And this took inspiration from the code of ethics that governs the audit of GRA. So I'm sure most of us are familiar with these professional framework stuff. So confidentiality. So these are the professional principles, okay? Confidentiality, objectivity, professional competence, professional behavior and due care, and integrity, okay? Now, for confidentiality, as I explained, you as a tax auditor, you must maintain confidentiality on the client you work on, okay? You must maintain confidentiality on the client you work on. Now, objectivity, you need to be objective. You don't need to be, you don't need to include any bias in your words. You need to ensure that you say it as it is. If it is A, it is A. If it is B, it's B. You question matters as they are. You don't include any form of biases. Professional competence, as a tax auditor, this is one of the most important things. You need to have a skills and competence in carrying out your mandate as a tax auditor. So you must possess the necessary skills and trainings. That's why most especially, even after we charter, we attend programs to boost our understanding of tax audit, to boost our understanding of tax in general, so that we keep ourselves afloat when it comes to tax matters. Professional behavior and due care. As I don't expect a professional to be somewhere maybe involving him or herself in certain things that connote like a bad act. Okay, so as a professional, you need to professionally carry out yourself amongst the public because you are representing a professional body. Integrity, you have to be straightforward, you have to be truthful, you have to be honest. Professionals do not lie. Professionals are honest. Anyway, these are written in books. I'm sure when it comes to the practical aspects, you find professionals lying and all that, but then I'm doing my work as a teacher. professionally, we must be truthful, okay? And that is what will keep you going. That is what will keep you going. If you don't speak the truth as a professional, one day, things will catch up on you, okay? Now, in our quest to go through these professional principles and maintain these professional principles of objectivity, confidentiality, trying to be independent, trying to put up a professional behavior and all that, trying to be professionally competent, we will be faced with some threats, as I mentioned earlier. These threats are things that will not allow us to be independent and will not allow us to carry out our tax audits in a good way. Now, we have these threats had been grouped into five main threats. So we have familiarity threats, self-interest threats, self-review threats, advocacy threats, and intimidation threats. Now, all these threats are things that will not help you carry out your professional principles well. Let me state, some of these threats might overlap. If I say might overlap, examples that you can give yourself for, let's say, self-interest threats, facing a self-interest threat might seem a perfect example also for familiarity threats. So let's say, for example, you've lived with your father all your life. Your father has a company. You don't want your father's company to collapse. They are going to conduct a tax audit on your father's company. Because you are familiar with your your father, and you're familiar with your father's business, you don't want anything of your father to go wrong. If you are being put on an audit team to audit your father's business, you are faced with a familiarity threat because you are too familiar with your father and you might not be objective or independent of whatever work you are doing. The same way, you have an interest in your father's business. In your father's will, when he dies, he's going to hand over the company to you. You have an interest. So based on that, you are faced with a risk of a threat of familiarity and a threat of self-interest. In exam, you'll be asked some of these questions. Feel free to argue your point out. If you are going for familiarity threat, you know how to explain it. Same example could also be self-interest threats. Okay. For another example of self-interest threat, if you go for a loan from a bank and you are on the tax audit team of that bank, you don't want the bank to collapse because you've been going there for loans. So you have a financial interest in the company. Okay, so that gives you an opportunity to cover up any tax audit liabilities you see so that the bank will not collapse. Because maybe you've seen something big that can make the bank collapse. So your independence is threatened. So you can have other examples as well. These are open examples that we can always form examples once we have a self-interest or we have an interest in the taxpayer's business. The next one, let me talk about familiarity threat as well. Let me just conclude on that. Well, once you become familiar with someone, there's a likelihood that you are not going to be prim and proper with how you are going to do your tax audit. That is why at some point, there is some sort of rotations during tax audits. Okay. As I move along, I'm talking about the safeguards as well. If you are faced with a threat, it means that you are unable to carry out professionally your professional principles well. If you have an interest or you are familiar with the taxpayer, you are not going to stop the audit or you are not going to resign from your company, no. Because you have a threat, you need to apply a safeguard. And safeguards are applied to mitigate the risk or the exposure or the impact of these threats. So for example, once you realize that your father is the owner of the company, you told your audit manager, my father owns this company. I have interest in the company. I'm not independent. You can be replaced with another person. So you removing yourself from that particular audit assignment to another audit assignment is a safeguard. It can also be that maybe you are not a key person on the team. Maybe you are not the team lead, you're not the supervisor, you are just a normal team member. So then they will let you do the job all right, but then your work will be reviewed by an independent accountant who will see to it that your work has no form of loopholes. So that is also a safeguard. Another safeguard can also be, maybe you are the manager on the team. Because you are the manager of the team, you have significant influence. You would bring in another manager who would co-manage the assignment with you. And based on that, you are going to what? You are not going to have your way in terms of not reporting things that you see on your father's company. It's a safeguard. Another safeguard can also be attending continuous professional development programs, CPDs, where you are trained as to some of these threats. You are enlightened about some of these examples, what you can face during tax audits. And based on that knowledge as a professional, you might not be able to conceal information about your father's company if you have to bring it out. Okay. So those are some of the safeguards. And mind you, safeguards are applied in every threat instance. But know that the best safeguard should be applied in every instance, because then based on the situation, you know how best a safeguard you can employ to be able to mitigate the risks of that exposure or threat. Self-review threats, as the name suggests, you are reviewing what you have done. Let's say I'm a young man starting life. I've really been seeking employment with GRA, but I've never gotten the opportunity to. So I had to learn this accounting software, building accounting software for companies and all that. So I built an accounting software for A Limited. And at the end of the day, I know how you can hide information for A Limited. I know how you can manipulate their system and all that. Years down the line, I find myself to be working with GRA as part of the audit team, and I happen to audit A Limited. In that instance, I'm conducting a tax audit on a system that I really know very well, and I know where the taxpayer hide their stuff. I am basically going to do a review of whatever I have done for them in the past. So self-review threat comes with the tax auditor performing like multiple related services for the taxpayer, and your tax audit should be independent. So once you are performing a service that is not independent of the tax audit you are going to do, you are facing a threat. And some of these threats, you can renounce your membership in the team and join another audit. Most of the examples I give on the safeguards will still apply and all that. So normally with self-review threat, we are going to face a lot. Personally, having a strong financial audit and a tax background, I face this threat a lot. When taxpayers find me doing tax audits, supervisions, they want me to help them on financial audit side, to help them on that side as well. When companies see me doing financial audits, they also tell me to help them on the side of tax audits. Most especially, there is an instance where I was doing a financial audit. The company was experiencing a tax audit around the same time, and the company, knowing my background, they wanted me to also assist. So okay, so I am faced with that threat, and it is something very hard. Normally, what I do is I create a Chinese wall. If I'm doing tax audits, I tell you that, okay, if you need assistance on financial audits, I have the financial audit team. You can always reach out to them. I can connect you. You liaise with them on your matters. If I'm doing financial audits, I tell you there's a specialized tax team. You get to them, your matters are going to be resolved, not through me. Okay, so basically that's the safeguard I normally employ in doing that. Advocacy threats. One morning I wake up. Yes.
Please, I want to find out in normal corporate setting, normally some of our external auditors, they give us an advice on, like the companies normally contract their external auditors to be their tax advisors. Can it be a threat in that regard?
Okay, good. So nice question. So this cannot be a threat if there are proper safeguards put in place. The first and foremost, once the same audit firm is the tax advisor, the same firm is also doubling up as the financial auditors, there is a threat. No two ways about that. How are they managing the threat? You realize that their tax unit is a special unit with different staff from their audit unit. Okay. So if their tax unit is having like different like crop of staff, their audit unit is having different crop of staff. When they work independently. The manager on the job is not managing for tax and is not managing for audit. They have different manager for tax, different manager for audit. They do their work independently using different systems. Then there is a safeguard in place and it is okay. Okay, so where I previously used to work, I used to work with Deloitte Ghana, and in Deloitte Ghana, I was with the audit unit. Okay, before I joined Deloitte Ghana, I was with another firm. I used to work in the audit and tax units concurrently, but then for my tax aspects, anytime I do tax assignments on assignment that are not my audit client, because that was a special safeguard for me. Same thing applies when I was in Deloitte. I was doing financial audits, but then most of my clients who know me, I do tax reviews for my non-audit client with serious safeguards and serious independent confirmations completed before I'm able to do that. Okay. And it was rare because as part of the audit unit, we were just 2 people doing that, especially assessing the tax team on tax engagement, but then on our non-audit client. And we had strict documentation on that for us to be able to do that. So normally it's a safeguard that matters. If you're able to carry out the safeguard so well, you are able to mitigate whatever risk. I hope you are fine.
Yeah, okay. Yes, sir.
Okay, so advocacy threats. Waking up one morning, seeing one of our colleagues on radio promoting the shares of a taxpayer. No, you are advocating for them. I don't expect you to be doing that as a tax auditor because you find yourself auditing them and you're also going to advocate to promote their shares. It's not done. Okay. I've spoken about familiarity threats. Let's move on to intimidation threats. Intimidation threats is where you are intimidated by something, and as a result, you are not able to perform your mandate well as a tax auditor. Let's say, for example, someone who has always been afraid of going to court. Anytime the person hears of court case, the person is going to cry from childhood. Now, this person is a tax auditor. He comes to do a tax audit for a company. Then he raises a lot of liabilities. Then the CEO will say, hey, you this small boy, when did you start working? Eh? Your boss is my classmate. We go way back from, let's say, Adisadel College. If you don't withdraw some of the reports, I'll take you to court. If I don't take you to court, I would report to my friend for you to be sacked. You know, my friend trusts me more than you do. And you know, this is a young graduate who is doing his or her work as a professional tax auditor. If you intimidate the person about court cases, the person might withdraw whatever liabilities. It is a threat because if one of your fears, someone has mentioned to you that, and the liability was yourself that found out the actual liability. So you are just placed in a fix to say, okay, no one will find out. Let me just drop it. Okay. So that is a threat. So these are the 5 threats I wanted us to find out to discuss about. And these are a lot of safeguards that we can employ, as I've explained during these sections. Okay. Now we have key elements of the legal framework of tax audits. The legal framework of tax audits. Key element of the legal framework of tax audits. So here, legally, taxpayers are supposed to keep proper records. Okay. Now, after they keep the proper records, these records must be accessible by tax officials. Now, tax officials giving access to also things like third-party confirmation sources to be able to also confirm whatever audit that they are doing. So they are able to confirm evidences from third-party sources. So legally, the legal framework of tax audit talks about taxpayers keeping proper books of account, tax officials having access to those proper books of account, tax officials also having the mandate to have access to third-party information and also to other countries for information as well. And GRA having the legal powers to amend taxpayers' returns and provide sanctions for non-compliance. So these are the key elements of the legal framework of tax audits. Briefly, I want to talk about a few tax investigations. So post-clearance audits. So when I say post-clearance audit, GRA has done a tax. So you have done clearance of your goods from the port. Okay. After you have cleared your goods, GRA want to see whether you did the right thing, you had proper documentation, you pay the right amount of taxes at the port and all that. So they'll conduct what we call post-clearance audit after the clearance of your goods had been done. Okay. Now, these post-clearance audits really helps a lot because they are able to know whether you are paying the correct, you paid the correct amount of taxes at the port, you do not have any infractions or any form of loopholes in your importation and all that, and you are keeping proper records. Okay, so basically that's what post-clearance audit does. So they request for documents like your import documents, inventory book, your sales records, bank statements, and all that, just to do that special investigation. Okay. Forensic audits. So forensic audit is also very key. Forensic audit, as the name suggests, has to do with fraud. So where there is a lead on fraud, you are able to, how do you call it? You are able to do an investigation on why or how the fraud occurred. So normally forensic audit has legal consequences, and normally it's done 100%. Like they are gathering evidence with 100% kind of work because they are not leaving any stone unturned on that fraud case that have been identified. But we have types of forensic audit, and this the examiner likes it so well, differentiating between what proactive and reactive forensic audits are. So when I say proactive, if you say someone is proactive, it means you acted before an incident. If you say you are reactive, you acted after the incident had happened. So in simple terms, proactive forensic audit is conducting a forensic audit on a perceived or alleged fraud case. So before that forensic audit occurs. But reactive is what we normally do, where the fraud occurs and you call on the forensic team to investigate. What are some of the forensic investigative tools that are employed? So they do background investigations, they interview knowledgeable persons, they obtain documents from confidential sources, they do some form of laboratory analysis of physical and electronic evidence. So they can be doing like a test on fingerprint, facial recognition tests and all that. They can do undercover operations like ANAS does. Okay, but that one they are putting their life at risk, but then it needs to be done well. Then analysis of financial transactions, analyzing financial statements to see how the fraud occurs, if it's financial statement related. Okay, so you can apply forensic audits in doing your normal statutory audit. So forensic audit tools can help you to do your like normal audit. So your normal financial audit. When you are checking for maybe company compliance, when you want to check whether a company is complying with relevant laws and regulations, these forensic audit techniques. So here we are looking at how forensic audit is able to help in conducting other kind of audit or other forms of audit. So it helps in statutory audit, checking regulatory compliance. It's a diagnostic tool. So if I say diagnostic tool, I mean a tool that is being used to uncover a problem. So if maybe management wants to uncover an issue or uncover a problem, it can use these forensic audit tools to uncover problems that the company is facing, and also investigation of allegations as well. Okay, let's join as soon as the call ends. Let's quickly join as soon as the call ends, please.